All right, let's look at the S&P 500 like we usually do. You can see we're down 0.5% since last week. We are still overbought and we are still above all of the moving averages that we're following. Um, so if we look at our seasonality chart, February ended up being a bad month actually. So seasonality worked out just like it has on average for the past 40 years. Um, so right now we have a situation where we have a war going on, and that involves a lot of uncertainty. And whenever there's uncertainty in the market, you can throw all these charts away. Everything we're doing with stochastics and everything we're doing with average price returns. Um, and the stock market kind of goes with emotions. So we can see that March, April, May are traditionally better months. Then August, September, and June are subpar months again. So keep that in mind. It worked out this time. Um, yeah, we do have a situation right now where we are above all the moving averages. We have momentum and we are overbought. And add on top of all that, we're right at the beginning of a war with Iraq. Um, so we'll explain to you a little bit later how to deal with a war. Sometimes wars are positive for the stock market, especially defense companies. So you can't assume that if there's uncertainty in a war going on, that it's not going to be good for the stock market or bad for the stock market. I guess you have to be neutral. But we'll go over some of the ramifications of a war a little bit later on. Okay, so we just got out of earnings season. NVIDIA had its earnings report and it was better than expected. That will be the last big earnings report of the earnings season. Um, March doesn't have a whole lot going on. We have triple witching the third Thursday of the month. That's options expiration, and it's going to be very volatile that day. We also have the Fed meeting in the middle of the month. But in general, there's not a whole lot of catalysts as far as earnings for the stock market to catapult or make the stocks go up or down. Okay, so we do have, mm, I marked the months that are on average some of the worst months in red. So we'll keep those in mind. Right. So let's look at the earnings reports from this week. Um, we had NVIDIA was the most important earnings report. We were talking about NVIDIA, and let's look at the stochastics chart for NVIDIA. Okay, there it is right there. You can see we've been in a sideways pattern for over a year and a half, and we're approaching the bottom part of this channel right now. Um, we had a very good earnings report, and the stock sold off. So that's an example of buying on the rumor and selling on the news. Even everyone in the stock market was expecting very good earnings report from NVIDIA, and they came through and they had good guidance. So everything was in line for the stock um, to do well. But there were, I think the reason it went down was buying the rumor, selling the news. The stock went up. Look at this. The stock went up in anticipation of those earnings, and whenever the earnings came out and everything was expected, the stock sold off. So it's buy on a rumor, sell on the news. All right, so that was a good lesson learned. And Dell came out with earnings, and they had better than expected AI um, orders. So they went up like 20%. And that is all I can say for earnings this week. Next week, we have a lot of no-name companies, not a lot of big companies reporting anymore. We have Target, CrowdStrike, Broadcom, Marvell, Costco. Those are much smaller companies, and they're not going to be moving the markets a whole lot. Right. So S&P is down 0.5% from last week. It was a very volatile week. And, you look at only 0.5% and you say, wow, um, it seemed worse than it was. So we still have a little bit of momentum in the stock market. It's actually the momentum is going down. It was 65% above the moving average for the S&P for the 50-day and 200-day last week. Went down at 62. So we have declining momentum. We have the short range S&P short range oscillator overbought at 1.4. This is Jim Cramer's favorite gauge for um, sentiment in the market. Whenever it's positive, say if it's above zero, then it's overbought. And whenever it's like 5, then you know it's super overbought. Whenever it's negative, that means it's oversold. And the reason why you keep track of these things is you want to buy when the stock market is oversold and sell or don't buy whenever the stock market is overbought. All right, so the interesting thing about the US Treasuries, let's look at the current US Treasury. You can see that we went down in a major way this week. Um, that affects a lot of sectors. We'll go over a little bit later on. Um, but that is just an amazing move in a short amount of time. Okay, so what else do we have to say? Okay, so now we look at some of the catalysts for the stock market to go down. Fight or geopolitical events. And that is what is happening right now with the war in Iraq. Tariffs and lack of confidence in the AI story. So we have a combination of lack of confidence in the AI story and geopolitical fights or wars. So that is causing uncertainty in the stock market. The biggest problem right now with a war in Iraq is we have a uncertainty in the supply of oil for the world. So, okay, so let's go over our game plan from the beginning of the year. Um, we've been saying this for a while, revert to the mean. Healthcare, telecom, financials, energy, utilities, biotech did worse last year, and um, they're doing better this year. So returning to the mean is our theme for this year. S&P 500 is pretty expensive, and over time, it'll revert to a lower multiple. So let's just watch and see if that happens. All right, let's look at the S&P 500 in the trend lines. You can see we're at the bottom part of our trend line right now, and we're still overbought. So we have to watch these moving averages. Right now we're at the 100-day moving average, which is the green line, and the purple line is the 150-day moving average. The purple line below that is the 200-day moving average. And if you have the S&P 500 go below any of these moving averages, that kind of stops our uptrend in our channel lines. Then we have to draw totally new channel lines, and that's not good for the stock market. That means usually that it goes down 5 to 15%. Okay, so we are overbought. Um, I mentioned this before, whenever the oscillator is above 5 and or exceeding 8, that suggests the market is overextended. So we are overextended right now. And when it's below -5, we're approaching -10, that means that market is heavily oversold. So we've been saying it's been overbought for quite a while right now. Um, and it's starting to go, it's it's starting to go down to a point where it's oversold, but not yet. Okay, so we already mentioned the 10-year going down. There's a lot of ramifications for the 10-year going down. One of them is that really helps the housing market because it makes mortgages more affordable for someone buying a house. And right now we have one of the lowest mortgage rates in a long time. Okay, so let's look at some of the major variables in the stock market. The price of oil went up a lot whenever US attacked Iran with Israel. It's up 18% from last week. So what's happening is the war in Iraq um, is causing uncertainty in the supply of oil because a lot of oil goes through the Strait of Hormuz. Iraq closed it, as far as I understand. So the supply goes down for oil around the world. That means the price goes up. And the major benefactor of this, of course, are the energy companies. So any oil company is going to go up exponentially this week because we're going to be at war for at least a couple of days to a couple of weeks. We don't know. But the key thing for oil is it's inflationary. Um, it makes it's one of the biggest input costs for products around the world because you have to deliver the product after you make it for food, for every product. So for some products, it's more of an input cost than others. But that's the price of oil. If the gas prices go up, consumers will spend less and they'll default more. So the financial companies will have a problem because they might have some more defaults than they normally will because of prices going up. So let's look at inflation. It's about the same as last week. And the dollar index is unchanged from last week too. The price of gold is up 5.2% from last week. Whenever there's uncertainty in the stock market or around the world, if there are geopolitical events like wars that the United States are getting into, people gravitate towards hard assets such as silver and gold. So we'll keep our eyes on gold. Um, all right, you can see the US dollar index has continued to go down. Um, and that is good for multinational companies when they report their earnings. But it's bad for you and me because it's going to cost more to buy a bunch of bananas every year if the purchasing power of a dollar goes down over time. Okay, fear and greed index. We're at fear right now. We were at fear last week, so it hasn't gone up or down since last week. But we are fear with the war. I could see that going to extreme fear. So let's see if we go into an extreme fear or oversold market this week sometime. But the translation is whenever the market is fearful, you want to be greedy. And that means start looking for things to buy. All right, so the AAII, American Association of Individual Investors survey, let's look at that. They're more bearish than bullish. So that's another indication to start looking for something to buy or don't sell. Okay, so the VIX right now it's at 20. I mean, there's fear beginning, but with the war starting, that's going to go up a lot, probably to 25 or so. Um, so right now we're starting to have a lot of volatility, and um, this is a time that you have to look at what you own and see, is it really affected by any of this that is going on around the world and in general around AI. Okay, so right now we are in the fear stage of your emotional feelings. So, so right now, let me see, war in the Mideast. Okay, so issues that may lead to a crash. War in, I've had this on here for like what, 2 years, 3 years. War in the Mideast, Iran, Israel, new war, overextended fighting racks up lots of debt, and that in itself is something that leads to uncertainty. And the stock market does not like uncertainty. What's going to happen? What's the reason why the 10-year is going down so much? Let's look at this. Could be there's a high demand for safe assets when there's uncertainty around the world. And so we expect the 10-year to keep going down as the stock market is volatile. So it's supply and demand. The more something is in, the more U.S. Treasuries are in demand at the auctions, the lower the yield is going to be for the U.S. Treasuries. All right, so let's look at the worst at first. We were saying this all last year, and about the worst from last year. Um, it took a while for it to happen, but right now, the worst from last year are actually outperforming the best from last year. And you can see communication services, IT are some of the worst, and financials are some of the worst sectors this year. What's happening right now with the war is where whenever there's uncertainty around the world in the stock market, people gravitate towards safer investments. The safest investment is the U.S. Treasury. The sectors like energy, materials, utilities, and consumer staples are safe sectors. Sectors that pay dividends, healthcare is another safe sector. It pays dividends and constant demand in good times and bad. And that's what's happening right now. People have been switching in the last week into safer sectors. All right. It's always good to review this sector valuations relative to history. Last year, we were saying how and in IT and communication services were trading above their 10-year, 30-year averages. And the financials, real estate, healthcare, utilities, and energies, they have been trading way below what they normally trade for in valuations. So what's happening right now is stock market is moving and rotating from the expensive stocks into the less expensive stocks that are safer. All right. Let's look at, okay, let's look at the asset returns quilt. You can see that in the past, you have a big disparity between a large cap performance and, let's say, energy performance. Energy, international dip. Okay, so this situation with with oil going up and conservative sectors going up and tech going down is another reason why you have to have a very diversified portfolio so that you can handle any situation such as this one. Okay, so let's look at some of the sectors that are going up and down the most. Dell went up a lot because they had earnings come out and they were much better than expected for data center, AI data center server orders. We had Paramount Skydance. They won a bidding war for Warner Warner Brothers, I think it is. Um, Block. They are a company that reduced its workforce by 40%, and they said it was because of AI. And that's a canary in a coal mine, they call it. It could be um, there's a couple narratives. We'll go over the word narrative a little bit later on, but there are a couple narratives in the stock market right now where AI could lead to massive layoffs because AIs could be replacing white collar workers. And if that happens, then you have a lot of financial companies that lend money to these same people. Um, they might experience defaults, and there might not be as much money spent by the white collar workers that are laid off. So right now there was a big, that's why Block went up 16% because they had efficiencies that allowed them to fire 40% of their workforce. The reality is that Block, they hired three times the amount of people they started with three years ago, and now they're just downsizing a little bit. So I think it's this the leader of Block isn't that great in allocating resources. He used to own Twitter, and Elon Musk cut the Twitter workforce exponentially, and it's still working. So that could be a canary in the coal mine that there's going to be a lot of layoffs, or it could be just his poor allocation of resources for his company. Netflix is up 13% because of debt. They were in the bidding war for a company, Warner Brother Discovery, and they stepped out of that. And because they're not spending 50 billion on that company, then they're not going to incur the debt for that, and that made the stock go up. So debt is a major issue with companies. If a company takes on too much debt, then people will not pay as much for it, and it could get into trouble paying that back. Other companies that are in the top, you see APA, they're a oil company. So on Monday, there's going to be half of these, at least half of them are going to be oil companies just because of the war and the price of oil. Let's look at these stocks going down the most. We have United Airlines. We have Apollo. Why would United Airlines be going down? Well, the price of oil goes up. That's their biggest input cost. So Delta Airlines, a lot of companies that depend on lower prices of oil could be affected by the war in Iraq. We have Apollo Global Management. Okay, well, there's a lot of problems right now with something called private credit, where these companies lend money to non-public companies. And the issue with this is that sometimes um, if you have to liquidate some of your portfolio, um, you could take a big hit. And these companies, like private credit companies like Apollo, weren't meant for liquidations on a regular basis. So the whole business model around private credit companies is pretty sketchy. So I'm staying away from that. American Express is down a lot. I didn't really see the news for this. We're going to go over some of Warren Buffett's companies, including American Express a little bit later. Um, this is an example of a time when you keep a track of Warren Buffett held companies, and whenever they're selling off, and he is committed, Warren Buffett's committed to holding them forever. It's a good time to start looking at them. A lot of financials are selling off, I think, based on the narrative that if there's a lot of layoffs due to AI, then people aren't going to pay their cards back, or they're going to default on their loans. So that was a good little exercise. All right, let's look at the sectors going up and down. Okay, so let's look at our cheat sheet. Okay, yields are going down. That is positive for any company that needs to borrow money. Small cap stocks, home builders, speculative companies that need to borrow money, and REITs. High yielding stocks will also be affected because people will be reaching for yield. So they're looking for high dividend paying stocks. Let's see if, and it's negative for large cap financials, brokerage firms, insurers. Let's see if that happened this time. Okay, telecom, high dividend paying. So that makes sense. The interest rates for the 10-year go lower, then telecom companies are higher demand because they have high dividends. You have oil and gas. As of Friday, this is Friday, they're going up because of the price of oil and because of they pay high dividends in that sector. Gold miners, gold, the price of gold went up 5%. So that gold miners go up with the price of gold. Healthcare, high dividend, safe sectors. So these are all safe sectors that are paying high dividends. Utilities, biotech, biotech, they go up because it costs less to borrow money with lower interest rates. Let's look at the ones going down the most. Regional banking. Okay, these are due to that theme I was just saying about how people might not be able to pay their bills and without jobs. You have tech companies, then retail, metals and mining, home builders. I would expect home builders to do well because home builders benefit from lower interest rates. So let's see the negative for large cap tech stocks, financials, and banks. And that's the sectors that went down the most. Okay. Okay, that was a one-to-one correlation. So a lot of what's going on in the stock market today is of the 10-year, because of the 10-year. Let's look at that 10-year. Okay, forget it. Okay, so let's look at Dan Now's picks from the beginning of the year. This Impinj has been a real loser. It's down 30%. But Dan Now's, he's still sticking with it. He had a comment recently. He said the RFID tech is still in high demand and he believes in it. Apple is down 3%. Nike is down 2.8%. Cisco is the only stock that is up, and Boeing. So Boeing is an example of a halo stock. We'll talk about halo stocks a little bit later on. Okay. Okay, here's I did a search on Google for current stock market narrative. In the AI overview, which is pretty accurate, it says, as of late February, the stock market narrative is a shift towards moderate bearishness in tech, driven by a post-earnings sell on the news reaction from AI leaders like NVIDIA. See that sell on the news. Concerns over sticky inflation. And that's even being exaggerated by the price of oil. That hurts inflation. While the Dow has recently hit record highs, the NASDAQ is under pressure and it's right at the moving averages, like I mentioned earlier. The key themes for the drivers are inflation and rates. Hotter than expected producer price data for December has caused the stock market to pull back. It fueling fears the interest rate cuts may be delayed. So this higher than expected producer price data, that's going to go up even more with higher price of oil. So that is another reason why the stock market would go down. Um, with higher inflation, that means the Fed cannot cut interest rates, and that does not help the stock market. AI is cooling off. There was a big run up in the AI stocks, and investors are taking profits and putting it into um, more conservative things. Sector rotation. Capital is shifting away from high-flying technology, with investors following the Dow's more defensive-oriented composition. Technical resistance, okay, and market sentiment. Okay, so I put together this little investor game plan. Um, rotate into more conservative stocks from high growth tech stocks. Look for companies with high free cash flow and low debt. Buy small amounts of quality companies as they sell off. Look for stocks selling at a low PEG ratio, safe from disruption, and rotate into undervalued sectors relative to history. We've already talked about the undervalued sectors compared to history. We mention that every week. Um, so that is that is my game plan for this week. Now we have a war in Iraq. Um, the biggest effect of this war is the price of oil is going up a lot. That is inflationary. Consumers, when they pay more at the gas pump, they're going to have less to spend on goods. And those goods are increasing in price due to inflation. So this is all a problem for the U.S. economy. Uncertainty with the oil supply, um, that causes the price to go up, and um, it makes and it makes the cost of doing business higher for businesses. Um, another problem is, will the demand for U.S. goods and services go down? And how will that affect the growth rate of stocks? If if people in Iraq or in the Mideast ban American-made phones or something like that, could that affect the stocks we're following? Okay, ramifications of being in a war. Um, we don't know if the American goods are going to be bought anymore, and we don't know how this is going to affect the stocks we're studying. Um, so what's happening right now is investors are switching from risk on to risk off. I put the categories in the stock market as risk on, communication services, IT, financials, industrials, consumer discretionary, and stocks that went up a lot year to date. So these are stocks that have high P ratios, high PEG ratios, and usually don't pay much of a dividend. So whenever the stock market goes down, we usually have a rotation from risk on to risk off. And risk off usually involves gold, silver, materials, energy, consumer staples, utilities, healthcare, defense companies, and real estate. These are companies that pay a dividend. They have low PEG ratios, low PE ratios usually. So let's see if that happens this week. Okay, I picked out a couple interesting charts. I'll make this bigger so we can see it. Okay, gold. You can see that gold is in an uptrend from multiple years, if from two years ago. Um, you can see that it's right in the middle of its trend line, and it's overbought right now. But with global uncertainty, the price of gold is going to continue to go up. We have XLB. This is the materials sector. You can see that it's in an uptrend, and it's overbought right now. But The material sector is helped by the falling dollar. As the dollar DXY index goes down, the price of most commodities goes up. So the materials sector is like a one-to-one correlation to the price of commodities. Okay, so let's look at healthcare. You can see that we broke our downtrend for a healthcare sector right here. That was in September. And we started going up. And you can see that this is a sector that pays dividends. It's overbought right now, but there's some stocks that are in the 10, less than 10 PE ratio. And so they're very undervalued compared to the rest of the market. But they have a consistent healthcare stocks have consistent demand. They pay a dividend and they're considered conservative in times of uncertainty. Okay, we have the industrial sector. Um, you can see that it's halfway between its trend lines and it's overbought right now. Um, but it's in an uptrend. Let's look at the staples select sector. These are stocks like Procter and Gamble, Colgate. They pay a dividend and they sell things that everyone needs, like toothpaste and deodorant and Tide. So that is an example of a stock that is sector that is conservative, pays a dividend, and safe. And those have been super out of favor. They've been in a sideways pattern for multiple years. And they broke out of that sideways pattern right there. And you can see that they're in an uptrend. Utilities. Utilities have two good things going for them. One is that they have a high dividend. And as the interest rates for the 10-year Treasury go down, um, sectors that pay high dividends are high demand. And they also have a growth aspect to them where their AI data centers are going to provide them a lot of business. Let's look at XLE. You can see that there was a sideways pattern here for the energy stocks. It broke out of that sideways pattern right there, and it's in an uptrend right now. It'll be at the end of this war in Iraq. I'm sure that it'll be up higher than this. But the energy sector also pays a dividend, something like 3% average, 2 or 3%. And the home construction ETF, I'm surprised this isn't doing better. You can see we're in an uptrend. We're oversold right now. In um, we have lower mortgage, we have lower interest rates on a 10-year, and the mortgage um, rate is much lower than it's been in a long time, and that's all helping the home construction ETF. Um, I picked out some conservative stocks that I own that I'm super comfortable holding them in any environment. One of them is waste management. Waste management is a stock that it's a stock that has a duopoly with Republic Services. So there's two big trash companies in America. And as households grow and as we have bigger projects with the government, the amount of trash goes up every year in good times and in bad. And they can raise their prices on a regular basis because they have pricing power with the monopoly. Also, on top of this, they make money on recycling and energy from methane from some of their landfills. So they are an example of a stock that is AI proof. You, and they actually are using technology in their recycling and other ways to automate some of the um, functions they're doing. They also have a unit they just bought called Stericycle. So they are handling waste for health companies also. So they're growing in that sense too. So um, you can see they haven't really done anything in quite a while, but they're an example of a halo kind of company that is almost impossible to disrupt because one of the reasons why they have a moat is it's very hard to get a permit for a landfill these days. And they've already gotten their permits, and other companies are going to have a hard time getting permits. All right, let's look at NVIDIA. Okay, this is you can we mentioned last week that they're in a sideways pattern, and we were talking last week about how it's very possible that you have a buy in a rumor and sell on the news, even if they have great earnings report. They had a great earnings report, but they went down like 10%. They're approaching the bottom end of this um, channel, the trend lines, and they're also approaching the 200-day moving average, which is very important for support. Now, even though their stock is undervalued, it doesn't mean the stock market can't sell the stock further. And we'll go over NVIDIA a little bit later, just to see what the numbers are after the earnings. But you can see that um, they're halfway between overbought and oversold right now. And they are above the 200-day moving average. But let's see if it holds that 200-day moving average and the bottom end of this channel line. Um, Here's another stock, Eli Lilly. It has been in an uptrend since last August. Um, you can see that it went down 20% on a bad report about a competitor drug. And ever since then, it's been going up. It's in a sector that's in favor right now, the healthcare sector. It pays a dividend and it's growing around 30%. So they had some studies comparing their products to Novo Nordisk weight loss, and theirs is superior. So basically, all the doctors are going to be um, prescribing this weight loss, Eli Lilly's weight loss instead of Wegovy. Also, another thing for a catalyst for this company is they have a pill coming out for weight loss, and as soon as that is approved, the stock's going to go up a lot. Okay, so I did a stock screen. We get the same names coming up every week. Um, there's a couple let's look at the actual. Let me see. Hold on. Stock screen. Okay. I thought it'd be interesting. We have the same ones we've been looking at for a while. I thought it'd be interesting to start look at oil companies because just because we have some um, they are considered out of favor right now and sometimes they're a little bit undervalued. So you can see ConocoPhillips, we have Energy Transfer, we have Phillips 66, Valero. So whenever you see a bunch of stocks that are in our stock screen, then it might be a good idea to start looking at some of these oil stocks. I thought it'd be interesting to look at Phillips 66 because it has a PEG ratio of 0.3. So that was very promising. So I thought it'd be interesting to look at that one. Okay, so let's look at that. Okay, you can see that Phillips has a growth rate around 11% this year. So it has a 3.29% dividend, so that's a total return of 14%. So the PE ratio is 12. So right now it's 0.85 PEG ratio. Yahoo Finance says it's 0.48. So that means it's undervalued by around 15%. The profit margin isn't that great at 3.3. Its return on equity is 15, which is great and what we were looking for. So higher price of oil will definitely help the profit margin. So it operates, okay, it operates um, they're an energy provider and they operate in multiple countries and they do refining, midstream chemicals, marketing and specialties and renewables. Okay, so they do a little bit of everything. Um, so right now they're just a little bit undervalued. So this would be a good stock to look at further. Let's look at the next little story. Berkshire Hathaway's CEO suggests these four companies are forever stocks. Okay, so we have Greg Abel taking over from Warren Buffett at Berkshire Hathaway. He wrote a shareholder letter, and in that letter, he said he identified four large Berkshire equity investments that are they're going to hold forever. So the great thing about knowing this is I'm sure that he had asked Warren Buffett about this. Warren Buffett um, believes in these companies, and some of these companies are going down a lot. American Express, look at that, down 8%. Um, Referring to the four companies, Abel said, they are businesses we understand. We have a high regard for their leaders and expect to compound over decades. The concentrated approach will continue with limited activity on these holdings. We may significantly adjust a holding if we see the fundamental change. So that's a good hint that these are stocks that you can buy and hold without changing your position. They signaled that they're not going to sell any more of their Apple. So whenever we have this sell-off in the stock market this week, keep your eye on some of these better stocks that could be the buy and hold type stocks. Moody's had a drop of like 15% last week because they were fearful that AI would interrupt their business. Perhaps if AI could somehow understand, do what they do, they probably have a moat that you can't have AI make reports that like they do. They're a rating agency, so there's only like five or six rating agencies in the world right now. So they have a certain moat that can't be disrupted. But we're going to watch these and Warren Buffett's companies in general during the stock market volatility to see if we get any entry points. What I'm looking for American Express is I'm looking for like a peg ratio of less than one. Right now it's expensive, and I've been saying it's expensive for a while, but whenever there's uncertainty around the economy and AI layoffs in the tech world, that could give a long-term investor an opportunity to invest in American Express. All right, but let's keep our eyes on those. Um, what I'm going to look at is Apple too. We're going to look at Apple. Um, this is one stock that Greg Abel says that they're going to hold forever. Um, you can see that Apple is growing 10% from this year to next year and then 6% the year after. So their PE ratio is 31. So it's pretty expensive. They're three times overvalued. And let's look at what Yahoo Finance says. They said they're 2.39% PEG ratio. That is, that means they're around two to three times overvalued. The translation for us is this stock could go down in half from where it is in a bad market, and that could be a good entry point if you're interested in buying it. And the profit margin is off the charts. That's really good. That's Warren Buffett wants 20, at least 20, and return on equity is much greater than what we're looking for. We like something above 15, and it's 10 times that. Um, and look at this. They used to be a cash-rich company. They during the pandemic, whenever interest rates were very low, they borrowed a lot of money at very low interest rates. So they have um, 30 billion more in debt than what 25 billion more in debt than they do in cash. So a lot of companies, not Apple hasn't been spending a lot on AI, but a lot of companies like Google are spending a lot of their cash flow on AI infrastructure. We're starting to see Apple turn from a cash-rich company to um, a debtor company. So let's keep an eye on that. But out of 3.88 trillion, this is a rounding error, so it's not that big of a deal. Um, all right. So let's look at another stock of Warren Buffett's that he's going to hold forever is Coca-Cola. Let's look at that. And it's a perfect stock for an environment that's uncertain like we have right now. With the war, people are still going to be drinking Coca-Cola. One of the great things about Coca-Cola is you have brand loyalty. People don't switch from Coke to Pepsi or very easily. Very similar to how people have brand loyalty with Apple devices. I guess you can say brand loyalty, Apple, brand loyalty, Coke. I don't know. You can have, are people loyal to their American Express? Not as much. But definitely have loyalty in Coca-Cola and Apple. Let's look at their PE ratio. It's 25. And they're only, let's see what they're growing right now. They're growing, okay, Coca-Cola is growing at 7%. You can see from this year to the next year at 7%. And they have a 2.53 dividend. So their total return for owning this stock is 9.5% a year. So their PE is 25. It's always been an expensive stock. Its PE is 25. You divide 25 by its dividend or total return is 9.5, and you get a PEG ratio of 2.5. That matches what Yahoo Finance has. So it's a very rich stock. Um, it's trading for right around what the stock market, the S&P 500 is trading at. Its profit margin is greater than 20. That's great. And its return on equity is double what we're looking for. And total cash, they have 30 billion in debt, which is not much compared to the market cap. A lot of companies right now are being penalized for having large amounts of debt. And especially when there's uncertainty in the stock market and uncertainty around a theme such as AI. Um, let's look at let's look at Moody's. I don't have, let's go up just a little bit. Okay. Moody's is growing around 13%. I have the numbers here. I don't know how it got on the next page. Moody's is growing at 12%. The PE ratio is 29. That means they're 2.4 PEG ratio. That means they're 2.4 times overvalued. Let's look at Moody's, another stock that Warren Buffett, um, Greg Abel is going to hold forever. Their forward PE is 29, and so they're growing at 12%, and they're 29. That means they're two times overvalued. Their profit margin is greater than 20, and that's great. The return on equity is three times what we're looking for, and they have 5 billion debt out of 8 billion, which isn't a whole lot. So this is a really the richest one of all the stocks that that we're following here. Um, so I would wait for this to go down in half to buy it because right now it's pretty ritzy expensive. But you can see that it has decelerating earnings. Every year it grows by 1% less. So that's not so great, but it is consistently around 12% every year. Okay, this is a very interesting article from Goldman Sachs. Has a stark message for investors in AI stocks. Um, Goldman, they have coined a term called a halo effect. The halo trade is asset-heavy stocks win the rotation. So halo means heavy assets and low obsolescence. Right now, the big worry is AI going to make a company obsolete? And according to Goldman Sachs, the bank's basket of capital-intensive stocks has outperformed Capital Light Group by 35% since the start of last year. Um, so the kind of stocks that are halo, grids, pipelines, utilities, transport, infrastructure, critical machinery, and they're example of halo businesses. Boeing is an example of a halo business we're following. Um, so specific stocks, ASML, LVMH, they do luxury goods. Air Liquide and Airbus, they're a company that makes airplanes. Deere, ExxonMobil, Southern, and Duke Energy. Okay, so there are some that say that people should be rotating into some of these more conservative sectors. Um, there's a high replication barriers. So assets are hard to copy due to immense capital costs, intense regulation, or the case of luxury manufacturing and brand quality. So just think about Boeing. You know how hard it would be to replicate making airplanes on the size that they're making airplanes. Um, let's look at low obsolescence. These assets retain their economic value over long technological cycles. Um, Goldman Sachs noted their basket of Halo stocks outperformed IT stocks like software IT by 35%. The Halo trend res represents a shift towards tangible old economy assets in an area dominated by AI capital expenditures. All right, so basically, here's some examples of Goldman Sachs says there are winners and losers of the AI race. And for software, he likes they like Microsoft, Oracle, CrowdStrike, Palo Alto, and Cloudflare. So all these stocks have been sold off with the software SaaScopolis that's happened this year. And so you can see that what you have to do is look at the moat of the company. Let's look at why Goldman thinks that these software stocks are going to survive. Microsoft has cloud and AI infrastructure that virtually every large enterprise depends on. The switching costs make it extremely difficult. Just think if you had to change from Windows to Linux at your office workstation, how hard is it going to be for you to send an email and for everyone in the whole company to change? That's probably not going to happen. Um, database systems so embedded in corporate workflows that replacing them carries enormous cost. Oracle is an example of a company that took on a lot of debt to fund their AI data infrastructure, so they're being punished because of that. CrowdStrike has sold off along with Palo Alto because they're a software related company. But in general, cybersecurity demand for cybersecurity is not going to go away. It's actually going to be um, more critical, not less, as AI tools multiply the attacks. Um, so we went over CrowdStrike and Palo Alto before. They were super expensive, and they're still expensive right now. So I would wait for the cybersecurity stocks to go to a peg ratio of 1 before I would be interested. Right now they're much higher than that. Um, let's look at some of the stocks that are losers. Um, just think of if you asked an AI agent to make an app like Monday.com, you could be displaced in like a month, but how hard is it to replace Microsoft's Windows? That is like a big difference. Um, CRM, Salesforce, they have core workflow automation that AI agents are beginning to replicate without a paid subscription. So DocuSign, I can, this is an example. It's really easy to recreate this. Adobe already has a replacement for DocuSign, and Adobe's already on everyone's desktops. Um, so we have to we have to keep in mind or the Warren Buffett 20-year rule. Like when we buy a company, we want it to last, and we want to be able to buy and hold it for 20 years or more, or forever, according to Warren Buffett. Um, okay, let's look at NVIDIA, and because they came out with their earnings, they were stellar, and their earnings outlook was stellar, but the stock sold off. And that's an example of buy on the rumor and sell on the news. So let's look at their numbers. Um, the forward PE is only 22. That's around what the stock market is trading at. Their growth from this year to next year is estimated to be 73%. That is just outrageous for a company this big. The PEG ratio is 1.0 according to Yahoo Finance. But if it is growing at 74% and the P ratio is 22, you divide 22 by 74 and you get a PEG ratio of 0.23, which is 4 times undervalued. That doesn't mean it can't go to 5 to 10 times undervalued. It just you have to understand what it's really worth. So you have to multiply its current price by 4, and that's its fair value. But the profit margin is double what we're looking for at 55. The return on equity is 100, which is 5 times what we're looking for. And they have 40 billion, 45 billion in cash, which is um, all perfect. I mean, everything about the numbers for this company are really great. The one problem is they have decelerating estimates going out 2 or 3 years. So maybe it's selling for 22 times earnings because in 2 years it's only going to be growing at 16%. That is the question. But we've been following these earnings for multiple years now, and they've never been right in 2 years out. So what to keep that in mind. But this is an example of a stock that's um, it went down to $100 a share, last year. So it's a very volatile stock. So you have to keep in mind what it's truly worth, um, and keep that in mind while you're holding the stock. Okay, I thought it'd be interesting in this very conservative time of the market, time whenever stocks are going down a lot, what the a dividend growth stock is holding right now. These are stocks that pay a dividend and they have some sort of growth that they're safe. And this is T. Rowe Price dividend growth. They own Microsoft, Apple, Broadcom, JP Morgan, Visa, GE Aerospace, Bank of America, Chubb, Eli Lilly, and Walmart. You can see that the thing that all these have in common is there's a steady demand for their products in good times and bad. Walmart, if there's a recession, if people are laid off, where are they going to go? Target? No, they're going to go to Walmart. Um, and so Walmart does good in the good times and the bad, and they pay a dividend. Eli Lilly, they have um, the best product for weight loss right now in the stock market, and they're only getting better. And they're in a conservative sector, and they pay a dividend. Um, Chubb, I don't know anything about insurance stocks, so I'll skip that. Bank of America, it's an example of financial. They pay a dividend. Um, in 20, 30 years, there's still going to be a JP Morgan and Bank of America lending money and having credit cards. Visa has a 90, between Visa and MasterCard, they have a 90% share of credit cards around the world. And Microsoft, they have a monopoly in Office, in Windows, and they're growing their AI cloud business at like around 35% a year. Warren Buffett likes Apple because they have high brand loyalty and they have over 2 billion active iPhones in the world. So, and they have an ecosystem where they're charging people for services. And that's very hard to displace. So all these stocks have that in common. I don't know if Broadcom really fits in there, but they pay a dividend. All right, that was a good exercise. Um, all right. I think that's all I had to say for today. I hope you enjoyed that, and I hope you have a good investing week. Talk to you later. Bye.